What's up, guys? It's Dan from TPFX. I see a lot of people making some completely random and outright ridiculous statements about the MACD and how you can use the MACD to implement it in your strategy. I think it's probably one of the most misunderstood indicators. So in today's video, I just want to cut through all of the crap, show you exactly what the MACD is, show you exactly what each component is and explain how they work, and then more importantly, show how you can use it to your advantage as a trader. So let's just get stuck into that straight away. When we first look at the MACD, I think it's probably quite a daunting indicator. There's quite a considerable amount of information and it probably looks quite random to someone that doesn't actually understand what they're looking at. So let's just break down what the MACD actually is. The first thing that we want to take a look at is this center line just here. In theory, anything above is bullish, anything below is bearish. There's obviously various ways that we can look at that, and there's various ways that we can interpret the information that we're being given. So let's just explain what the rest of the components are now. So we're using the standard parameters that the MACD gives you. Okay, there's no need to change absolutely anything. The first thing that we want to look at is our MA lines. These are just two standard moving average lines. The blue one is obviously a bullish MA and the orange is obviously a bearish MA. So in theory, what that says is when the blue is on top of the orange, we're in a bullish market. When the orange is on top of the blue, we're on a bearish market. So some people will trade based on which direction the MAs are facing. So for example, at the moment, our MAs are facing down and they look as if they're about to cross this center level into the bearish side, meaning that they would be looking for sells. Some people look to trade based on crossovers. So as the MAs cross over, that signals them to be able to, in this particular scenario, take a sell, or here where they've crossed over, this would signal that they would look to take a buy. Both of these, so which way the MA is facing and when there's crossovers, in my opinion, are completely wasted strategies. There is no point to them whatsoever. We see MACD, MAs give readouts like this consistently across all time frames, across all currency pairs. So there is just no sustainability in using the MACD to trade like this. It's a complete waste of time. The next thing that we're going to take a look at is the histogram, or the histo, as I'll refer to it in the setups that we send. And when we talk about the histo, we're referring to these blue and red bars just here. I think these are most commonly mistaken for what they actually represent. So a lot of people look at these and they think it represents volume. Okay, now the only way that we can see volume on a currency pair in a particular time frame through a particular period is to apply volume to our chart. That is then going to show us volume. What the histogram is showing us is the difference in that volume. So if we have a big blue mark up here, we know that there is considerably more bullish orders in this market than there is bearish orders. If we have a big red build up just here, we know that there is considerably more bearish orders in the market than there is bullish orders. So it doesn't give us volume, it gives us the difference. Now, more often than not, when we see these really small build-ups, if we were to apply the volume indicator, we will see that the volumes are right down as well. However, when it comes to trading, we can never make an assumption. So in theory, a currency pair can have the highest volumes it has ever seen. And if 50% are on the bull side, 50% are on the bear side, we are going to see these small little build-ups instead of these big chunks. We're only going to see these big chunks if one side of the market is seeing considerably more orders than the other side. So remember, we can never make an assumption. The histo shows us the difference of volume, not the volume itself. So what can we use the MACD for? Okay, the MACD, I like to use the MACD for divergence. Now, different traders have different meanings in terms of divergence and convergence and what they're looking for to be able to utilize it in their trading strategy. I'm a patterns trader. We teach people how to trade patterns and we teach people how to use the MACD in relation to the patterns that they are trading. So we get true divergence and we get partial divergence. Partial divergence is when we have divergence across one of these components, so either our MAs or our histogram. True divergence is when we have got divergence across both. What is divergence? Let's just take a look at that now. First of all, we need to understand that the MACD is only going to be relevant and effective when it is used in a trending market. So when we can see the market is moving in one particular direction and creating higher highs and higher lows. The MACD is not for use when we are seeing a range. If you're wanting to use an indicator for the range, I'd recommend the RSI, but that's not personally something that I use. MACD only relevant in a trending market, bullish or bearish. So divergence is looking at these swing highs and swing lows in a particular direction. And if we were going to be seeing divergence on a move like this, what we would expect to see is that we might start with a big chunk for this high. The next high is going to have come down, and the final high up here is going to have come down even more, and our MAs will be doing the same. So our price is pushing in one direction and our MACD is showing us the complete opposite. So price is climbing here, MACD is coming down. The same would be true if we were in a bearish market. So we might see that the price is creating lower highs and lower lows, and all the while we're doing this, we are seeing that actually the MACD is starting to turn up. So this is showing us that a particular move is weakening, or it's showing us price manipulation. So if you're just trading higher highs and higher lows, when it gets to here, for example, you might look to buy, when in actual fact, if we've got strong divergence, you could end up seeing the break of a structure followed by this trend then reversing. So just trading a trend or higher highs, higher lows is not going to give you any real sustainable or consistent trading plan. This allows us to see through what's actually happening up here. In my opinion, no indicator is going to give you the answers, and it's really important that you understand the MACD is a confirmation tool. It is not a sole means to take a trade. So just because you are starting to see divergence does not mean you can say, okay, well, we've got divergence, I need to sell this pair. This must be used in partnership with a trading plan. So as I say, our trading plan is we teach people how to read patterns, how to trade patterns, why those patterns form. When the MACD is used as a confirmation of these patterns, it's a very effective trading strategy. But if I was to trade divergence by itself, I'd probably be lucky to have a 20% success rate. Trading it with patterns in the way that we do and the way that we teach means that you're able to see somewhere between, obviously it varies per person, but ours is up in the low 80s in terms of success rate, which is really, really good. And if you've got a decent risk management plan, to be honest, 80s is perfectly fine. The people that put trading strategies up that say 95, 99% success rate, it's simply a lie, especially if it's an indicator that can give a 99% success rate. Things like this just don't exist in Forex. So let's now take a look and see if we can spot some examples of this on a real chart. So if we look just here, we can see we've got higher highs and higher lows forming throughout this trend move. This is actually a rising wedge, but if we then move to our MACD and see what our MACD is showing us, we can see that with each push to the upside, so the data that we see on the MACD represents the data that is directly above it on our price action chart. So taking that into account and looking at each of these highs, what does our MACD show us? The first high, there is a considerable amount of bullish orders in comparison to the bearish. The next high, we have got much less bullish orders in the market. And the next high, we've near enough completely dried up in terms of the difference in orders. Yet the price is still continuing to move to the upside. So the MACD is showing us that this is weakening. Now, as I say, that in itself is not enough to take a trade. The trade comes off the break and pullback of this rising wedge. But the MACD has been used to confirm that this is not a true trend move. it is a manipulation to make way for this. So that is an example of divergence across the histogram. And the reason that I cover the histogram first is because I personally give the histogram more weight than I give the MAs. So I do pay attention to divergence across the MAs, but I am more interested in divergence across the histogram. Why is that? The reason for that is simply because the MAs are showing us what we can already see on the chart. It's exactly that. It's an MA. It's a moving average. So it's taking a set amount of candles, adding them together and dividing them by the amount of candles that they are, and then giving us a readout in the form of a graphic depiction. And then it translates that into a line that flows freely across our MACD. So it is physically using the price action that we can see up here to create a graphic depiction down here. The histogram is giving us information that we cannot necessarily see up on our price action chart. So all of this can be manipulated, but the information that goes into this cannot be manipulated. What that shows us is what is physically going on. What this shows us is not necessarily what is truly going on, because as we know, even when the banks are manipulating the price, so they're doing so in the form of their smallest orders, so the volumes are really low, we might be seeing corrections or pullbacks, they are still moving the market. They are still in control of what is going on. Even their smallest orders are going to outweigh our largest orders. And there's no way for us to see that throughout this move, other than looking at our histogram. So if we now look at an example of how I'm saying you can see what the MAs are showing us on an actual price action chart. So just here on pound yen, we can see we've got a high and we've got a higher high just here. If we look at our MAs across this data, now remember that what is on the MACD is representing what is directly above it up here. So if we just extend this, we can see that the first high, the higher high, and what are our MAs showing us? They're showing us divergence. We've also got divergence across our histogram because it's not pushed up with the price. However, we would have no way of seeing this on the price action chart. But this, the average, we can see that this is going to have divergence here. And we can see that just by looking at the price action, the momentum, and the force in which it is moving with. The first high, just here, if we look at the price action that has moved into this high, it is very impulsive. It clearly has one direction. We are seeing some really big bullish candles pushing the price to the upside. If we then take a look at the second high that's forced the price up to create a higher high, we are seeing lots of wicks. We have got much smaller candles. We've got bearish candles within here. We've got dojis, hammers. There's all sorts of price action going on to show us that actually there's a lot of uncertainty around this level and the price is actually running out of steam to push to the upside. So what the MAs are giving us, we would expect to see, and a seasoned trader would be able to spot that you're actually going to have divergence across the MAs just by looking at this section of price action. So I'm not saying the MAs are not important. I'm just saying they show us what we can already see on a price action chart. The histogram does not. So let's quickly now see if we can take a look at another example where we've got both put together. So just here, we're looking at Euro-Yen 4-hour view. This goes back to 2019. And we can see that the price is creating lower lows and lower highs. So technically, this is in a secondary downward trend. If we compare these lows, so all across, it's no good looking at one low. So it's no good just looking here, and it's no good just looking here. We need to combine the data across these to see what our MAs and what our histogram is physically showing us. So our histogram has got clear and strong divergence. We can see that the amount of sellers here is much higher than the amount of sellers here, showing us that there's a potential that this move is starting to weaken. If we then look at what our MAs are showing us, they are now showing us that not only is the move physically weakening, but the momentum is also slowing as well. As I say, this in itself is not enough to just warrant a buy. You need to find a confirmed entry that allows you to get the trade, and this needs to just support the trade that you are taking. When I am looking to take a trade, my MACD will be down and minimized. I will always look at the price action and the structure. I will then pull my MACD up and take a look at what the MACD is showing me. I will never just look for lows and highs and try and find divergence, because that is going to taint your bias, and then you are going to be trading what you think and not what you physically see. Price action and structure must always sit in the driver's seat. This is just there to support either taking an entry or not taking an entry. But we can see the strength in all of the examples that we've looked at. You can see the strength in how the price has then moved away. So push down, impulsive move to the upside. There's actually an example slightly further back. We can see highs and a high again, and we can see across the highs the bulls have left the market, and then what's followed is the price pulling away. But I cannot stress enough that this is not a sole means to take a trade. It is a confirmation of what you have already analyzed in terms of price action and structure. I hope this video has given you a bit more of a clear understanding of how the MACD works and how you can use it as a trader. If you want to learn how to trade patterns and use the MACD as a confirmation to find your entries, then jump on our website www.tpfx.co.uk and become a TP student. Jump in our chat rooms, follow us on Instagram. We are all about value. If I give you stuff like this for free, imagine what's in our course and imagine what we give to our students. Make sure to drop a like and subscribe to our YouTube channel. Drop us a message if you've got any questions.